America just did something the papers barely explained, and if you're watching closely, it might change how the world remembers the dollar. So here's the story, plain and obvious. The U.S. Treasury quietly moved to backstop Argentina with roughly $40 billion worth of support. A move that happened while parts of the government were politically distracted and without the kind of public debate you'd expect for money that large. At first glance, they call it a currency stabilization partnership. But let's cut through the spin. What actually happened is this: the Treasury used a tool most people have never heard of, the Exchange Stabilization Fund, or ESF, a fund created in the 1930s to allow fast, confidential intervention in foreign exchange markets. Small correction worth pausing on: that fund's origin goes back to Roosevelt-era currency policy. When the U.S. changed the official dollar-per-ounce parity of gold from about $20.67 to $35, which created a one-time revaluation profit for the Treasury. That profit was never simply spent in the open congressional process, and part of it became the base. The ESF gives Treasury officials legal authority to step into volatile currency markets without the usual congressional vote, because it was designed to be an emergency, flexible tool. Now they've used it to buy Argentine pesos, swapping dollars for a currency that has been hyperinflating, in some periods running at rates well over 100%, and they've done it in concert with private investors who are being asked to put in the second half of the funding. On paper, the story the Treasury tells is, this isn't a bailout, it's stabilization. We're defending the peso to keep Argentina in the global financial system and to prevent a ripple effect that could hurt regional stability and, ultimately, the dollar's influence. That's a defensible public policy argument. But two important questions follow: who benefits and who bears the risk? Look at the beneficiaries first. Hedge funds, distressed debt investors, and sovereign managers have, over recent years, bought enormous sums of Argentine bonds priced at severe discounts because they were betting on a political and economic turnaround. If Argentina's bonds collapsed entirely, those funds would take huge losses. Who sits in the room with the Treasury now? Many of the same financial players. That is not necessarily illegal. It is, however, a conflict of interest risk and a political lightning rod, especially when the operation is framed as not a bailout. The second question: who carries the downside? Technically, the ESF is supposed to manage risk so taxpayers aren't on the hook. Practically, when the Treasury holds a hyperinflating currency as collateral, the risk transfers back into the public balance sheet if the currency continues to crumble. Losses have to be made whole somehow, and historically that has meant either drawing on other Treasury resources or issuing new debt. That is the uncomfortable math the official narrative prefers to leave off camera. So, what's driving the decision beyond immediate rescue politics? The bigger strategic picture is about influence, particularly the U.S. desire to keep China from expanding financial leverage in Latin America. China has been active across the region with loans, infrastructure dollars, and currency agreements. Washington's argument is simple: if the U.S. doesn't step in, Beijing will cement economic ties, push its currency into local markets, and weaken dollar dominance. Stabilizing Argentina is therefore framed as defending the dollar and protecting long-term strategic interests. It's a geopolitical case as much as an economic one. Now, how did the Treasury structure the deal? The first slice is an ESF-backed currency swap, dollars in exchange for pesos, which gives Argentina immediate breathing room against capital flight and panic. The second slice brings in private capital, banks, hedge funds, and sovereign funds, but they participate because the Treasury provides guarantees and preferred terms. That's the carrot. The problem is the collateral. Argentina's central bank hands over pesos as collateral, and the Treasury accepts them knowing they're losing purchasing power fast. In effect, the taxpayer is temporarily holding a melting asset. If the peso stabilizes and value returns, the market wins and private investors get returns. If it doesn't, the taxpayer pays. That trade-off is the political core of the controversy. So, what would make this operation smarter, safer, and more defensible for an American audience? First, full transparency and clear accounting. Publish the terms, the expected losses, the breakpoints at which private investors will be forced to absorb losses, and the contingencies if Argentina defaults. Second, change the narrative from not a bailout to structured stabilization partnership with defined taxpayer protections, because honesty disarms political critics and rebuilds public trust. Third, attach explicit conditionalities, independent fiscal milestones for Argentina, third-party monitors, and rapid triggers for private investor loss sharing, so it isn't a backdoor wealthy investor rescue. Fourth, diversify the stabilization vehicles. Combine currency swaps with targeted debt for reform swaps or commodity-backed guarantees that reduce pure currency exposure. Fifth, thread in a public diplomacy campaign that explains the strategic case clearly. Show the alternative, Chinese balance of payments support, yuan corridors, new local currency arrangements, and argue why U.S. engagement preserves long-run market openness. Finally, use the moment to expand responsible stablecoin regulation and international payment rails that facilitate private cross-border transactions in dollars without creating shadow exposures for the Treasury. Let's be blunt about optics. Handing the impression that billionaire investors get bailed out while farmers, taxpayers, and veterans tighten belts is political suicide. Any future plan must explicitly preserve domestic priorities. For example, tie new ESF operations to congressional review after the fact, or better, to a compact that sets clear guardrails. And from a storytelling standpoint, because you'll run this as a video, you must narrate these complicated moves with clear, repeated metaphors. Call the ESF what it is, a contingency war chest. Call private investors' holdings what they are, distressed baits, and call the risk where it lands on the public balance sheet if things go wrong. Walk your viewers through the chain, why pesos were bought, who stands to gain, how the Treasury thinks it will offload risk, and what that means for ordinary Americans. And on the concrete stakes, cheaper beef imports touted by politicians don't automatically help the family rancher if domestic production erodes. National security arguments about influence in Latin America are meaningful, but they don't absolve policymakers from providing clear, auditable accounting to the people footing the bill. In short, what looks like a quiet, technical operation is actually a big, political choice about how the United States defends its financial leadership in a contested world. And the way that choice is packaged matters, not only to the markets, but to the voters who will ultimately pay the bill. So yes, the Treasury can act fast, but smart policy should be fast plus transparent, fast plus conditional, fast plus fair. Only then can a stabilization deal be presented without sounding like a bailout for the already connected. And only then will the American people buy the argument that this was done in the national interest rather than as a rescue for private losses. If you want to understand what happens next, track three things closely: the terms of the ESF swap, the names and commitments of private co-investors,
and the fiscal conditions Argentina must meet. Those three readouts will tell you whether this was a prudent defense of dollar influence, or a near-term rescue that leaves taxpayers holding the bag. And if you're a producer making this video, close with a short call to action, tell viewers where to find the original documents, invite experts to comment in the description, and tease the next episode, how this could reshape the dollar's future. That's the story, cut clean, with the mistakes fixed and the stakes made unmistakable.